Something is breaking in the silver market, and if you are watching closely, you can feel it before you can fully explain it. Prices are not simply rising or falling in an orderly way. They are jumping, collapsing, and recovering with a speed that feels more like a stressed financial system than a normal commodity cycle. I have watched metals markets for years, through the 2008 liquidity crisis, through the 2011 silver spike, through the pandemic shock of 2020. And what we are seeing now carries the same kind of tension in the background. It is the kind of tension that tells you the surface story is not the real story. Look at the signals that are coming in and notice how they don't line up cleanly. Gold is moving higher in a relatively controlled, almost methodical trend, behaving exactly like a classical safe haven asset should when debt levels are high. Currencies are softening and geopolitical risks refuse to fade. But silver is behaving differently. Instead of following gold in a steady rhythm, it is surging far faster, then correcting violently, then surging again. These are not the movements of a calm market. These are the movements of a market where liquidity pockets appear and disappear, where positioning becomes crowded, and where leverage amplifies every shift in sentiment. Now, step back with me and think about the broader macro picture, because this is where the real explanation begins to emerge. We are living in a period where sovereign debt levels across the developed world have reached levels that historically lead to financial repression or currency dilution. Governments cannot easily tighten policy for long periods when interest payments alone begin to consume large portions of national budgets. That reality changes the behavior of central banks. And when central banks change behavior, the currency system changes with them. Precious metals begin to reflect that shift long before most people recognize it. But silver is not gold, and this is the critical point many observers miss. Silver lives in two worlds at once. It is a monetary metal, reacting to real interest rates, money supply growth, and currency confidence, just like gold. But it is also an industrial metal, deeply tied to manufacturing cycles, electronics demand, solar infrastructure, and technological expansion. That dual identity means silver does not move with one engine, it moves with two. And when both engines fire at the same time, the acceleration becomes violent. Across the world, the confirmation signals are appearing. Central banks continue to accumulate gold reserves, not as a speculative move, but as a strategic rebalancing of trust away from purely fiat reserves. Large economies are settling more trade in local currencies. Energy markets remain volatile, and geopolitical tensions from Eastern Europe to the Middle East continue to inject uncertainty into supply chains. None of these developments alone explains silver's behavior, but together they form the backdrop of a global system that is no longer as stable as it appeared a decade ago. And yet, here is the contradiction that makes this moment so unusual. Equity markets, especially in the United States, remain resilient. Corporate earnings have not collapsed. Employment data, while uneven, has not signaled a deep recession. Inflation, though persistent, is not spiraling out of control the way it did in the late 1970s. On the surface, this looks like a world that should produce moderate, orderly commodity movements, not explosive volatility in a metal like silver. That contradiction's the clue. Markets rarely behave irrationally without a structural reason. When you bring all of these pieces together, the picture becomes clearer. Silver is not behaving abnormally because of one event or one headline. It is behaving abnormally because it sits at the intersection of liquidity, leverage, industrial demand, and monetary uncertainty. It is the most sensitive instrument in the precious metals complex, the one that reacts first and most violently when stress begins to build beneath the surface of the global financial system. And if there is one conclusion I want you to take from this, standing here with me and looking at these charts and signals together, it is this. What looks like chaos in silver is often an early warning signal. Not necessarily of an immediate collapse, not necessarily of a dramatic crisis tomorrow morning, but of pressure building inside the architecture of the global economy. Pressure that eventually finds a release somewhere, somehow, in ways that always surprise the majority of investors. I want you to focus with me for a moment, because what we are seeing now is not just volatility. It is the sound of multiple macro forces colliding at the same time. When you look at silver moving 10% in a day or collapsing just as quickly, the instinct is to search for a headline, a rumor, a single catalyst. But that is not how structural shifts work. Structural shifts are slow, silent, and then suddenly visible all at once. And right now, several of those shifts are happening together. Start with the dollar. For decades, the global financial system has been built on the assumption that the US dollar is the ultimate settlement currency, the deepest liquidity pool, the safest reserve. But what happens when deficits remain structurally high, when debt to GDP ratios climb above levels that historically forced monetary accommodation, and when real yields struggle to remain meaningfully positive? The currency does not collapse overnight, but its gravitational pull weakens. And when the gravitational pull of the world's reserve currency weakens, even slightly, metals react disproportionately. Now, look at real interest rates, because this is one of the most important variables that many people underestimate. Precious metals do not compete with nominal yields. They compete with real yields. If inflation is running above the effective return on bonds, then the opportunity cost of holding non-yielding assets shrinks. We saw this dynamic in the 1970s when persistent inflation eroded purchasing power and gold and silver entered powerful secular bull markets. We saw it again after the 2008 financial crisis, when central banks flooded the system with liquidity and real rates fell deeply negative. And today, even though headline inflation has moderated, the structural forces, energy volatility, wage stickiness, fiscal expansion, continue to keep real yields under pressure. But there is another force at work, and this one is less visible to the public, but impossible to ignore if you have watched markets for years. Liquidity itself has changed character. Central bank balance sheets remain enormous compared to pre-2008 levels. Global M2 money supply continues to expand, and capital moves faster than ever through derivatives, ETFs, and algorithmic trading systems. This creates an environment where price discovery can become distorted. Markets no longer move only on fundamentals. They move on positioning, margin calls, volatility targeting, and the reflexive behavior of leveraged funds. This is where silver becomes uniquely sensitive. Because the silver market is smaller and thinner than gold, flows that would barely register in the gold market can create violent moves in silver. When speculative positioning becomes crowded, a single shift in liquidity conditions can trigger cascades of forced selling or buying. Those cascades are not emotional, they are mechanical. Risk models reduce exposure, stop losses trigger, margin requirements rise, and what looks like panic is often just the automatic unwinding of leverage. Now widen your lens even further, because this story is not only about Western financial markets. Across Asia, particularly in China, physical demand dynamics are changing the structure of metals markets. Strategic stockpiling, export controls, and growing domestic consumption of silver and solar technology and electronics are tightening the physical side of the market. When physical inventories decline while paper markets remain heavily leveraged, the system becomes fragile. It begins to resemble previous moments in financial history when claims on assets far exceeded the assets themselves. We have seen this pattern before, not only in metals, but in credit markets, in housing, in sovereign debt. The late stages always feel confusing because contradictory signals appear everywhere. Equity markets can rise even as structural risks build. Bond yields can stabilize even as debt burdens grow heavier. Inflation can appear contained even as long-term monetary expansion continues quietly in the background. These contradictions are not signs that nothing is wrong. They are signs that the adjustment is not yet fully arrived. And this is why silver feels so erratic right now. It is reacting not to one narrative, but to many narratives at once. It is reacting to currency movements, to industrial demand, to speculative flows, to real interest rates, to geopolitical uncertainty, and to the slow but undeniable shift in the global monetary order. When multiple forces push in different directions, the result is not a smooth trend. The result is instability, sharp reversals, and movements that feel irrational until you understand the machinery underneath them. So as you stand here with me and look at this market, what you are really witnessing is not just a commodity fluctuating. You are witnessing a stress test of the financial system itself, playing out in one of the most sensitive instruments in the world. And the truth is, markets often reveal stress in small, volatile corners long before the larger structures begin to move. Silver, more than almost any other asset, has a long history of being that early signal. I need you to stay with me here, because what we are about to talk about is the part most people never see, the part that operates behind the headlines and behind the price charts. When you hear that silver moved 10% in a single session, or that inventories are falling, or that volatility is exploding, those are only the symptoms. The real story is happening inside the structure of the market itself, in the plumbing, in the mechanics of how trades are settled and how risk is distributed across the system. You see, the modern financial system is built on layers of claims: futures contracts, options, exchange-traded products, swaps, and structured positions all create exposure to an asset without requiring the asset itself to change hands. This system works smoothly as long as confidence remains high and liquidity is abundant. But when volatility rises and physical supply tightens, those layers of claims begin to matter. Because at that moment, everyone holding a claim begins to think about the same question at the same time. What if delivery becomes difficult or expensive or delayed? This is not a new phenomenon. If you look back at the Hunt Brothers episode in 1980, silver prices did not rise simply because demand increased. Prices rose because leverage and concentrated positioning collided with the limits of physical supply. When the rules changed and liquidity evaporated, the collapse was just as violent as the ascent. And if you look at March of 2020, during the pandemic shock, you will remember how even the U.S. Treasury market briefly lost liquidity, how gold futures diverged from physical prices, and how transportation and logistics disruptions caused real shortages in bullion markets. Those moments were warnings that the system is not as frictionless as it appears in calm periods. What we are seeing now carries echoes of those episodes, not in identical form, but in structure. Registered inventories in key exchanges have been trending lower, while open interest and paper exposure remain extremely high by historical standards. That imbalance does not automatically produce a crisis, but it increases fragility. It means that price movements can become exaggerated because the buffer between supply and demand is thinner than it appears. And I want you to think about something else that is happening at the same time. Industrial demand for silver is no longer a minor supporting factor. It has become a structural driver. The expansion of photovoltaic capacity, electrification, and high-performance electronics has created a steady, persistent draw on physical silver. Unlike investment demand, which can reverse quickly, industrial demand tends to be sticky. Once a factory line or infrastructure project requires a material, that demand does not disappear overnight. This creates a baseline level of consumption that tightens the market even before speculative demand enters the picture. Now combine that with geopolitical realities. Trade tensions, export controls, and resource nationalism are becoming more common, not less. Countries are increasingly treating strategic materials as instruments of policy. We have seen this with rare earths, with energy, and increasingly with metals. When supply chains fragment, arbitrage becomes more difficult, and regional price differences begin to widen. That is another source of volatility, another source of stress that does not always show up in traditional macro models. But here is the contradiction that makes this moment so unsettling. Despite all of these warning signs, tightening physical markets, rising volatility, persistent fiscal deficits, and a monetary system under strain, the broader financial system still appears stable on the surface. Equity markets continue to function. Credit markets remain open. Banks are not failing in waves. To many observers, this creates the illusion that everything is normal. I have seen this pattern before, and I want you to understand it clearly. Systems rarely break when everyone expects them to break. They break when confidence is still present, when the majority believes the risks are manageable, when the signals are visible but dismissed as noise. In 2007, credit spreads were still relatively contained, even as the housing market deteriorated. In early 2020, global markets were still reaching highs, even as supply chains were already beginning to fracture. The turning points never announce themselves politely, and that is why the behavior of silver matters. Not because it predicts the future with certainty, not because it guarantees any specific outcome, but because it reflects stress faster than most assets. It reacts to liquidity conditions, to leverage, to industrial demand, and to monetary uncertainty all at once. It is like a seismograph in a financial system where most instruments only measure surface weather. So when you look at these violent swings, I want you to understand what you are really seeing. You are seeing a market that is thin relative to the forces acting upon it. You're seeing a system where the number of claims on metal far exceeds the metal itself. You're seeing the effects of a world that is slowly shifting away from the assumptions that define the last 3 decades of globalization and monetary policy. And the most important thing to understand, standing here together and watching these developments unfold, is that instability does not begin with a crash. Instability begins with patterns that feel strange, movements that feel exaggerated, and contradictions that cannot be easily explained. Silver is not just moving, it is signaling. And signals, if you have watched markets long enough, are often the first chapter of a much larger story. I want you to take a breath for a moment and look at the bigger picture with me, because when markets begin to behave this way, the most dangerous mistake is to focus only on the daily price moves. The real story is never in a single candle on a chart. The real story is in the direction of the system itself, in the slow shifts that take years to unfold and only become obvious when the process is already well underway. What we are witnessing now is not simply a metals rally or a period of volatility. We are watching the long aftermath of a global financial era that began in 2008 and never truly ended. That crisis did not disappear. It was absorbed into central bank balance sheets, into government deficits, into a system that became dependent on liquidity to maintain stability. Quantitative easing, near zero rates, and repeated interventions prevented collapse, but they also created a world in which debt expanded faster than productive growth. And when debt grows faster than the real economy, something eventually has to adjust: currencies, interest rates, or purchasing power. You can already see the pressure points forming. Governments are spending a growing share of their budgets on interest payments. Demographics in many advanced economies are reducing the tax base while increasing entitlement costs. Supply chains, once optimized purely for efficiency, are being rebuilt for resilience, which is inherently more expensive. These forces do not produce sudden explosions. They produce slow, persistent inflationary pressure and periodic financial stress. That environment is exactly the kind of environment in which monetary metals begin to behave differently. But I want you to notice something critical, something that often goes unspoken. Markets are not just driven by economics. They are driven by psychology. Confidence is the most important currency in the financial system. As long as investors believe that central banks can stabilize markets, that governments can service their debts, that currencies will hold their value, the system continues to function smoothly. But confidence does not disappear all at once. It erodes gradually, in small increments, in subtle shifts of behavior. Investors hedge a little more. Central banks diversify reserves a little more. Corporations hold a little more inventory. These are quiet changes, but together they reshape the system. Silver, because of its dual role and its sensitivity to liquidity, often reacts to these shifts earlier than most assets. It becomes volatile, not because the world is collapsing, but because the world is changing. It is like watching ice begin to crack on a river long before the thaw becomes visible from a distance. The surface still looks solid, but the stress beneath it is increasing. Think back to other historical transitions. In the late 1960s, before the Bretton Woods system finally broke in 1971, gold markets were already showing signs of strain. Central banks were defending the dollar's convertibility, but the underlying imbalance between U.S. spending and gold reserves was growing. The system did not fail in a single day. It failed after years of mounting pressure that only a few observers fully understood at the time. In the early 2000s, before the housing crisis erupted, credit markets were already sending warnings through widening spreads in certain segments and abnormal behavior in structured products. The signals were there, but they were scattered, and most people did not connect them. And this is where we are again, in a different form, but with familiar patterns. High debt, persistent deficits, geopolitical fragmentation, technological transformation, and a monetary system that relies heavily on confidence and liquidity. None of these factors alone guarantees a crisis, but together they create an environment where instability becomes more frequent, where volatility becomes more violent, and where assets that reflect systemic stress begin to move in ways that feel abnormal. I am not standing here telling you that a collapse is imminent, and I am not telling you that any specific outcome is inevitable. Markets are complex, adaptive systems, and they can remain stable far longer than many expect. But I am telling you from years of watching these cycles unfold that when a small market like silver begins to behave this erratically, it is rarely meaningless noise. It is usually a reflection of deeper currents moving through the global financial system. So, as you watch these developments in the weeks and months ahead, I want you to remember this moment, this pattern, this strange behavior that did not quite fit the official narrative of stability, because history has a way of revealing its turning points only in hindsight. At the time, they always look like isolated events, like temporary volatility, like markets simply being irrational. Only later do we recognize them as the early signals of a shift that was already in motion. And that is the final point I want to leave you with, standing here together and looking at this unfolding story. The silver market is not just a chart, it is a message about liquidity, about debt, about confidence, about the quiet transformation of the global financial order. Whether that transformation unfolds slowly or accelerates unexpectedly is something none of us can know with certainty. But the signals are there, and ignoring signals has never been a strategy that served investors, institutions, or nations well in the long run.